June 23, 2022. 2:42 p.m. Greenwich Mean Time. The U.S. dollar index hits 109, a 20-year high. 22 nations sign bilateral trade agreements. Agreements that bypass the dollar. $32 trillion in U.S. debt. $1.9 trillion spent on foreign wars since 2001. The consequence? A silent rebellion. This was not a market crash, not a bank failure. It was a tremor, a tectonic shift in the foundation of global power. For 8 decades, the world has lived under a single monetary regime, the U.S. dollar standard. It was the bedrock of trade, the measure of value, the ultimate sanction. It seemed eternal. It is not eternal. Every single one has fallen. The Spanish real, the Dutch guilder, the British pound. Each was the world's reserve currency. Each controlled global trade. Each was believed to be unbreakable. They all broke. They followed a pattern, a 7-stage cycle of imperial finance. The pattern is not a theory. It is a historical autopsy. We have dissected the corpses of dead currencies. We found the same 7 fatal wounds. Every time. The United States dollar is not special. It is not an exception. It is a patient in the same economic ICU. And the monitors are flashing stage 5. This is the story of the 7-stage collapse. The irreversible cycle that destroys every reserve currency in history. This pattern has governed the rise and fall of every economic superpower for 500 years. From the Habsburg treasure fleets to the British Empire, on which the sun never set. They all succumb to the same financial logic. Today, we connect the dots. From Seville in 1590 to London in 1944 to Washington today, we expose the framework. The 7 stages from ascendancy to oblivion. This matters now because the global monetary system is not cracking. It is fragmenting. Central banks are dumping U.S. treasuries. Nations are hoarding gold. Trade is being rerouted. You were told the dollar's dominance was permanent. You were told there was no alternative. History says otherwise. And history is repeating. The 7-stage currency collapse is a blueprint for imperial financial suicide. It is predictable, measurable, inevitable. No empire has ever avoided it. Not one. Here is the cycle. Stage 1, the hard anchor. The new currency emerges, backed by a tangible, scarce asset. It is trustworthy because it is convertible. It becomes the reliable tool for global trade. Stage 2, strategic dominance. The issuing nation achieves geopolitical and economic hegemony. Its currency becomes the mandatory medium for critical transactions, especially energy. It is enforced by networks, treaties, and, ultimately, guns. Stage 3, the confidence dividend. The world's implicit trust allows the empire to borrow cheaply, to run massive deficits, to export its inflation. A something-for-nothing era begins. Stage 4, peak extraction. The empire, addicted to the dividend, begins to weaponize its currency. It uses financial sanctions and seizes assets. It forces allies to bear economic burdens. Trust shifts from attraction to coercion. Stage 5, the silent run. This is the turning point. Global players, losing faith, begin a coordinated, quiet exit. They diversify reserves. They sign alternative trade pacts. They buy gold. But they still publicly affirm their belief in the system. The facade holds as the foundation crumbles. Stage 6, the liquidity trap. Foreign demand for the empire's debt evaporates. The central bank is forced to become the only buyer. It monetizes the debt, printing money to fund the government. Hyperinflation in asset prices follows, then in goods. The currency's value implodes from within. Stage 7, the reset. A new anchor emerges. A new currency, or basket of currencies, rises from the ashes. The old empire is burdened with debt denominated in the new money. Its standard of living collapses. A new financial order is born. The timeline varies. Spain's cycle lasted roughly 80 years. Britain's, from peak to dethronement, about 40. The American dollar entered stage 1 in 1944. It is now 80 years old. And every indicator, every piece of hard data, screams that we are in stage 5. The silent run is underway. July 1st, 1944. The Mount Washington Hotel, Bretton Woods, New Hampshire. 44 allied nations gathered not just to win a war, but to win the peace. To build a new financial world from the ashes of 2 world wars and a depression. The British Empire was bankrupt. The United States held over 70% of the world's monetary gold. The outcome was inevitable. The Bretton Woods system was stage 1, the hard anchor. The US dollar was convertible to gold at $35 an ounce. Every other currency pegged to the dollar. This was not a choice. It was a reality. By 1947, the US produced 50% of the world's manufactured goods, held 80% of global gold reserves, projected power through 800 military bases abroad. The dollar wasn't just a currency. It was a delivery mechanism for American food, fuel, and machinery to a shattered world. The Marshall Plan, $13 billion, over $150 billion today, was denominated in dollars. It forced reconstruction on dollar terms. The system solidified with a single, strategic commodity deal. 1974, Richard Nixon, Henry Kissinger, King Faisal of Saudi Arabia. The U.S. offered military protection. Saudi Arabia agreed to price all its oil sales in U.S. dollars, the petrodollar. Every nation needing oil needed dollars. Global demand for dollars became locked to global demand for energy. This was stage 2, strategic dominance. Complete. By 1980, over 80% of all international transactions were conducted in dollars. The eurodollar market, dollars deposited outside the U.S., exploded from nothing to a multi-trillion-dollar shadow system. The world now depended on a green piece of paper backed by the full faith and credit of the United States Treasury. And for decades, that faith was rewarded. The dollar was stability. It was liquidity. It was the deep, reliable market where the world parked its savings. By the year 2000, dollar assets made up nearly 70% of all global foreign exchange reserves. August 15, 1971, 9 p.m. Eastern Standard Time, President Richard Nixon addressed the nation from the Oval Office. He announced the temporary suspension of the dollar's convertibility into gold. The Bretton Woods anchor was severed. The dollar became a fiat currency, backed by nothing but trust and U.S. military power. This was the original sin, the pivotal moment that set the 7-stage cycle in irreversible motion. The United States now possessed the exorbitant privilege. It could print the world's reserve currency to pay its bills, to fund deficits without immediate consequence. The warning was immediate and clear. Treasury Secretary John Connolly famously told his European counterparts, "The dollar is our currency, but your problem." The initial warnings were ignored. The 1970s saw stagflation. The 1980s saw volatility. But the system held. Why? Because there was no alternative. The Soviet ruble? A joke. The Japanese yen? Too insular. The Deutsche Mark? Lacked depth. The dollar's dominance was a self-fulfilling prophecy. Its network was too vast to abandon. But the seed of stage 4, peak extraction, was planted. The weaponization began slowly. 1999, the U.S. forced the Swiss bank UBS to hand over records of Holocaust victims' accounts. A moral cause. 2001, the Patriot Act gave the U.S. unprecedented power to track and seize dollar-based transactions globally in the name of fighting terror. The tool was being forged. The fatal decision wasn't one day. It was a 30-year slope. The choice to finance endless domestic spending and perpetual foreign wars through dollar seigniorage. To believe the world had no choice but to absorb the excess dollars. To believe the trust dividend was infinite. Between 2000 and 2008, U.S. total public debt doubled from $5 trillion to $10 trillion. The trade deficit hit a record $800 billion. And yet, global dollar reserves kept growing. The world was trapped in a dollar trap. They had to buy our debt to stabilize their own currencies. They were financing our consumption, our wars. Nobody in power saw what was coming, because in their lifetime, it had never come. The dollar was the ocean. All other currencies were just boats upon it. They forgot that oceans, too, can recede. And the tide was about to turn. A reserve currency is not born from proclamation. It is born from undeniable, tangible value. It must be the most credible, trustworthy tool for storing and exchanging wealth. This credibility always begins with a hard anchor. Historical example 1. Spain, silver real, circa 1590. The anchor, silver from the Potosi mines, modern Bolivia. By 1600, Spanish America produced over 80% of the world's silver. The Spanish Real de Ocho, piece of 8, became the first truly global currency. It was trusted from Manila to Amsterdam because it could be weighed and melted. The stage lasted roughly 80 years, until massive counterfeiting and debasement began eroding the real silver content. Historical example 2. Britain, the gold standard, 1821 to 1914. The anchor, gold. The British pound sterling was legally defined as a specific weight of gold. The 1844 Bank Charter Act tied the issuance of banknotes directly to gold reserves. By 1870, over 60% of world trade was invoiced in sterling. Its credibility was absolute because any holder could, in theory, exchange notes for gold. This classical gold standard period was the pinnacle of Stage 1 for Britain, creating immense global trust. Historical example 3. United States, Bretton Woods Gold Window, 1944 to 1971. The anchor, gold at $35 per ounce. Foreign governments, not citizens, could convert dollars. U.S. gold reserves peaked at 20,000 metric tons in 1948. This anchor rebuilt the global trading system. World exports grew by 240% between 1948 and 1971. The stage ended with Nixon's 1971 decision, a clear signal that the anchor was becoming a constraint on domestic spending. The pattern is metallic, literal, and simple. Trust is physical. The empire provides a rock-solid guarantee. This stage builds the foundational credibility that all future abuse will eventually squander. With trust established, the currency becomes a tool of empire. Its use is no longer optional for key global transactions. It is mandated by economic reality and enforced by geopolitical power. Historical example 1. Spain, the treasure fleet system, 1560s onward. Dominance mechanism. Control of the world's silver supply. To trade with Asia for spices and silk, you needed Spanish reals. The Spanish crown mandated that all trade with its American colonies use Spanish ships and Spanish currency. A de facto monopoly. The famed Manila galleons shipped silver to Asia for 2 centuries, making the real the currency of intra-Asian trade. Historical example 2. Britain, the imperial preference and sterling area, 1930s to 1960s. Dominance mechanism. The sterling bloc, later area. Member countries, colonies, Commonwealth, held reserves in London, pegged their currencies to the pound, and gave preference to British trade. By 1945, nearly 50% of global reserves were held in sterling. The system was enforced by British naval power and the centralization of global commodity markets, like wool, tin, rubber, in London. Historical example 3. United States, the petrodollar, 1974 onward. Dominance mechanism. The U.S.-Saudi Security Pact. All OPEC oil sales in dollars. Global demand for dollars became structurally locked to energy needs. Countries had to earn or borrow dollars to buy oil. This created the recycling of petrodollars. Oil exporters deposited dollar earnings in Western banks, which then lent them to emerging markets. The U.S. Navy guaranteed sea lanes. The dollar guaranteed oil. It was a perfect, self-reinforcing loop of dominance. Strategic dominance institutionalizes the currency. It moves from being the best tool to the only tool for critical systems. This stage breeds complacency in the issuing empire. It mistakes structural captivity for genuine loyalty. Here, the empire discovers the magic trick. The world's deep, structural demand for its currency allows it to live beyond its means. It can borrow cheaply, spend lavishly, and export the inflationary consequences. This is the golden age of perceived invincibility. Historical example 1. Spain, the Habsburg debt cycle, 1550 to 1650. Despite rivers of silver, Spain was perpetually bankrupt. Why? It borrowed against future silver shipments from German, Fugger, and Italian bankers. The confidence dividend. Lenders believed the silver would never stop. Spain's borrowing costs were low because of its silver, even as it spent fortunes on endless European wars. The result, by 1600, interest payments consumed over 40% of the Spanish crown's annual revenue. The wealth was siphoned away before it even arrived. Historical example 2, Britain, financing World War I and II, 1914 to 1945. Britain financed its war efforts by liquidating foreign assets and borrowing massively in its own currency, something only a reserve currency could do. Its war debt soared from 25% of GDP in 1913 to over 200% by 1919. The dividend. Colonies and allies were forced to hold sterling balances and finance Britain's deficit. The cost of Britain's war was socialized across its empire. The consequence. By 1945, Britain was the world's largest debtor, owed £3.5 billion to its colonies, mainly India. The credibility was spent. Historical example 3, United States, the Great Moderation and Housing Bubble, 1991 to 2008. With the fall of the USSR, the dollar's position was unrivaled. Global savings gluts from Asia and oil exporters flooded into U.S. Treasury bonds. Long-term interest rates fell persistently, fueling a debt binge. The U.S. could run massive current account deficits, peaking at 6% of GDP in 2006, because the world recycled those dollars back into U.S. assets. The Federal Reserve, believing it had mastered the Great Moderation, kept rates low. This confidence dividend directly inflated the $8 trillion housing bubble. The confidence dividend is a drug. It feels like free money. It funds empires, wars, and social programs without immediate tax increases. The empire believes it has discovered a perpetual motion machine of finance. It is wrong. The trap. The Fed now holds over 20% of all outstanding U.S. debt. It is the marginal buyer. Foreign official holdings have flatlined since 2013. The initial liquidity flooded into stocks and assets, the 2020 to 2021 bubble. Then it hit goods and services. Inflation hit 9.1% in June 2022. The machine is now active. The liquidity trap is the financial point of no return. The empire is now funding itself with its own printed money. This destroys the external value, exchange rate, and eventually the internal value, purchasing power, of the currency. The confidence that took a century to build is incinerated in a decade. The old system collapses under the weight of its own contradictions. A new anchor emerges, often from a creditor nation with a stable, productive economy and a less politicized financial system. A new reserve currency or a basket of assets, like special drawing rights, gains acceptance. The old empire is left with debts denominated in a new, harder money. Its standard of living contracts violently. The cycle is complete. Historical example 1. Spain, the ascendancy of the Dutch guilder, 1648 to 1713. The reset anchor, Dutch financial ingenuity and the silver guilder. The 1648 Peace of Westphalia recognized Dutch independence. Amsterdam's stock exchange, central bank, and maritime insurance created a deeper, more reliable financial system. The guilder, backed by the Bank of Amsterdam's guarantee of silver content, became the new trade currency. Spain was reduced to a secondary power, burdened by debts now effectively denominated in guilders. Historical example 2. Britain, the Bretton Woods dollar supremacy, 1944 to 1971. The reset anchor, U.S. gold and industrial might. The 1944 Bretton Woods Agreement was the official coronation of the U.S. dollar. Sterling was relegated to a secondary, regional role. Britain's sterling balances became a crushing debt burden payable in dollars. Post-war austerity lasted for decades. The UK's share of global GDP fell from 20% in 1870 to under 5% by 1970. The reset meant permanent relative decline. Historical example 3. The United States, the emerging multipolar system, 202x, onward. No single heir is apparent. This is the critical difference. The reset is not towards one currency, but towards a multipolar system. Potential new anchors. Central bank digital currencies, CBDC's digital yuan for regional trade, bypassing SWIFT. Commodity baskets. BRICS proposals for a trade currency backed by a basket of commodities, oil, metals, wheat. Gold. A renewed role as a neutral, non-political reserve asset. Central bank buying is the precursor. IMF's SDR, an expanded role for the synthetic basket currency, diluting dollar dominance. The consequence for the U.S. Trillions in debt would be revalued against harder assets. The ability to fund deficits vanishes. Interest rates normalize at dramatically higher levels. The exorbitant privilege becomes an exorbitant burden. The reset is not necessarily a single day or event. It is a transition of financial gravity. For Spain, it took 30 years of war. For Britain, it took the 30 years from Suez to Thatcher. The U.S. reset is now in its early phase. The end state is clear, a world where the dollar is first among equals, not the undisputed master. A world where the U.S. Treasury must compete for capital like any other borrower. The seven-stage cycle is complete. It is a clockwork mechanism of imperial finance. Every reserve currency has followed this path from solidity to weaponization to abandonment. The data points are not random. They are milestones on a well-worn road. And the U.S. dollar has passed milestone 5. The historical autopsy is complete. The seven-stage pattern is irrefutable. The data is not circumstantial. It is diagnostic. And the United States dollar is at stage 5. The silent run. Right now, the facade of unshakable dominance remains. Treasury officials give confident speeches. Wall Street CEOs dismiss de-dollarization as a fantasy. But behind the curtain, in the vaults of central banks and the ledgers of energy ministries, the movement is unambiguous, coordinated, and accelerating. Current evidence, the stage 5 diagnostics. Gold acquisition versus treasury dumping. From Q1 2022 to Q1 2024, global central banks added over 1,000 metric tons of gold to reserves. In the same period, they were net sellers of U.S. Treasury securities. China has reduced its holdings of U.S. Treasuries by over $500 billion from its 2013 peak. They are trading paper promises for tangible metal. Bilateral trade agreements bypassing dollar invoicing. In 2023, for the first time, the majority of China's cross-border transactions were settled in yuan, not dollars. Russia-India trade is now conducted in rubles, rupees, and UAE dirhams. Brazil and China have agreed to settle trade in their own currencies. These are not minor players. This is the trade of commodities that underpinned the global economy. The weaponization feedback loop. A 2023 International Monetary Fund working paper found that countries facing U.S. financial sanctions have reduced their dollar reserve share by 5 to 15 percentage points. The 2022 Russian asset freeze acted as a global wake-up call. Saudi Arabia's finance minister stated publicly in 2024, "We will consider other currencies for trade. There are no issues with discussing how we settle our trade arrangements." The erosion of the petrodollar foundation. In 2023, for the first time, China purchased more oil from Russia than from Saudi Arabia and paid in yuan. India has become the largest buyer of Russian crude, paying in non-dollar currencies. The direct link between global energy demand and dollar demand is fracturing. This stealth diversification in reserve data. The dollar share of allocated reserves is 58%. But the unallocated reserves held by central banks, who do not report currency breakdown, have soared to $7.5 trillion, a black box where diversification can happen unseen. As Zoltan Pozsar of Credit Suisse noted, this is where the real action is taking place. This is the definition of a silent run. Public allegiance. Private desertion. Every stage needs a trigger. For the dollar's acceleration into stage 5, we have a precise date and event. February 26, 2022. A Sunday. The United States, European Union, United Kingdom, and Canada issued a joint statement. We will ensure that selected Russian banks are removed from the SWIFT messaging system. 2 days later, the The U.S. Treasury froze the assets of the Russian central bank held in U.S. jurisdictions, approximately $300 billion. This was not just another sanction. This was the demonstration of peak extraction, stage 4, in its most absolute form. The world's 11th largest economy, a permanent member of the UN Security Council, a major commodity exporter, was financially amputated from the global system overnight with the flick of a switch. The intended message was one of overwhelming power. The message received by every other nation, particularly those in the global south, was different. Your reserves are not your property. They are a political instrument of the U.S. Treasury. The catalyst was immediate. Within 72 hours, central bank governors from Beijing to Riyadh to Brasilia were in emergency meetings. The question was not about Russia. The question was, what if we are next? Every finance minister on earth realized a fundamental truth. The U.S. dollar system was no longer a neutral utility. It was a weapon. And you do not build your national economic security on a weapon pointed at your head. You find an alternative. The silent run went from a slow drip to a coordinated retreat. We can measure our position in real time. Here are the 10 indicators confirming stage 5. Central bank gold demand. 2010, net purchases of 77 tons. 2022, net purchases of 1,136 tons, a 55-year high. 2023, net purchases of 1,037 tons. What it means, the ultimate flight to a neutral, non-political asset. This is the most reliable signal of declining trust in fiat systems. U.S. Treasury foreign ownership. 2013, foreign official entities held 43% of outstanding marketable U.S. debt. 2024, that share has fallen to 30%. What it means, the world is no longer financing U.S. deficits willingly. The Fed is the buyer of last resort, the hallmark of stage 6 approaching. Dollar share of global FX reserves. 2001, peak 72.7%. 2024, 58.4%. The decline is steady, persistent, and accelerating post-2022. What it means, the structural demand for dollars as a savings vehicle is in a confirmed, long-term downtrend. Non-dollar trade invoicing. 2015, less than 20% of Russia-China trade was in non-dollar currencies. 2023, over 80%. What it means, the dollar is being bypassed at the transactional level for critical commodity flows. This erodes its fundamental utility. U.S. Net International Investment Position, NIP. 2000, minus $1.4 trillion. The U.S. was a net debtor. 2024, minus $19.2 trillion. The largest net debtor position in history and worsening. What it means, the U.S. is consuming far more than it produces, funded by IOUs to the rest of the world. This is the confidence dividend on life support. Federal debt to GDP. 2000, 55%. 2024, 122%, and projected to hit 130% within 5 years. What it means, the fiscal position is unsustainable without financial repression, the Fed keeping rates artificially low. This undermines the dollar's value proposition. Rise of alternative financial messaging systems. 2015, China's cross-border interbank payment system, CIPS, had a few dozen direct participants. 2024, CIPS has over 140 direct participants, including from major European financial hubs. What it means, a functional technical alternative to SWIFT is being built and adopted. BRICS expansion and rhetoric. 2009, original BRIC members. 2024, BRICS Plus includes Saudi Arabia, Iran, UAE, Egypt, Ethiopia. Over 30 countries have expressed interest in joining. What it means, a geopolitical bloc is forming explicitly to create alternative mechanisms to dollar-dominated institutions. U.S. real yield, inflation-adjusted interest rate. Despite high nominal rates, real yields have struggled to stay positive. What it means, foreign investors are not being adequately compensated for the perceived risk of holding dollar assets. Capital seeks better returns elsewhere. Rhetoric versus action dissonance. Public statement. 2024, U.S. Treasury Secretary, the dollar's dominance is secure. Private action, 2024, U.S. Treasury borrowing estimates relies overwhelmingly on domestic buyers. What it means, the official narrative is diverging from operational reality. This is the very essence of the silent run. The indicators are not isolated. They are interconnected symptoms of the same disease, the declining marginal utility and rising political risk of the U.S. dollar as the world's reserve asset. We are not at the beginning of stage 5. The gold buying began in earnest after 2008. The Treasury selling trend started in 2013. The 2022 sanctions were the accelerant. We are in the mid to late phase of the silent run. The exits are getting crowded, but the general public has not yet heard the fire alarm. The silent run does not end with a whimper. It ends with a violent repricing of everything. The consequences of the dollar losing its exorbitant privilege will bifurcate the world into winners, losers, and those who saw the pattern. For winners, commodity-rich, geopolitically neutral nations, countries like Brazil, agriculture, minerals, Australia, metals, and Canada, energy, mining, with stable governance and diverse trade relationships will see demand for their tangible exports remain strong, insulated from currency turmoil. Their resources will be the new bedrock. Gold and strategic commodity holders, nations and entities holding physical gold and controlling critical mineral supply chains, lithium, cobalt, rare earths, will possess the de facto hard anchor of the new multipolar system. Their assets will be revalued upward dramatically. The architects of alternatives, the financial centers that facilitate non-dollar trade, e.g., Hong Kong for yuan, Dubai for Gulf currencies, Moscow for ruble commodity trade, will see a boom in financial services and geopolitical influence. They become the new intermediaries. Domestic production economies, nations with robust internal manufacturing and less reliance on dollar-denominated imports, e.g., parts of Southeast Asia, India, will weather the currency volatility better. Self-sufficiency becomes the ultimate defense. For losers, dollar-dependent importers, nations holding large dollar reserves but importing essential food and energy, many emerging markets, will see their purchasing power evaporate as the dollar weakens and commodity prices soar in other currencies. Social unrest follows price shocks. The unhedged and unprepared, corporations and investors with unhedged dollar liabilities or portfolios concentrated in long-duration U.S. dollar assets, like traditional 60-40 stock/bond portfolios, will experience catastrophic real-terms losses. The safe part of the portfolio will become the anchor. The United States middle class. The end of the confidence dividend means the U.S. can no longer import cheap goods and export inflation. The standard of living, sustained for decades by dollar privilege, will contract. Higher interest rates, higher inflation, and lower consumption are inevitable. The social contract, funded by deficit spending, will break. Allies with fifth-column economies, nations like Japan and parts of Western Europe, with massive holdings of U.S. debt and deep integration into dollar financial markets, will suffer massive balance sheet losses. They are trapped. Abandoning the dollar triggers immediate crisis. Staying guarantees a slow bleed. Historical precedent for winners. The Dutch Republic in the 17th century. They were not the largest empire, but they built the deepest, most trustworthy financial system and became the indispensable commercial intermediary. Winners are not always the biggest military power. They are the most reliable utility. Historical precedent for losers. Great Britain Post, 1945. It retained the facade of global power, a UN Security Council seat, a special relationship, but its economy endured decades of austerity, devaluations, and IMF interventions. The loss of reserve status is a long, painful relative decline. Based on the historical compression of timelines, Spain, 80-year cycle, Britain, 40-year cycle, and the accelerated pace of information and capital flows, here is the projected path. 2025 to 2030. The denial phase, late stage 5/early stage 6. The silent run becomes audible. A major U.S. ally, e.g., Saudi Arabia, will publicly conclude a long-term energy deal explicitly in a non-dollar currency. This will be a watershed, front-page news moment. The Federal Reserve will be forced into permanent debt monetization, conducting QE during recessions, but unable to fully shrink its balance sheet in recoveries. Its balance sheet will surpass $10 trillion. Volatility will become structural. Sharp, unexplained dollar sell-offs will be met with official intervention and rhetoric, creating a volatile, sawtooth pattern in the DXY index. Gold will reach new nominal highs, decoupling from dollar pricing and becoming a leading indicator of distress rather than a commodity. 2030 to 2035, the liquidity crisis, stage 6. A failed U.S. Treasury auction. A major auction where primary dealers are left holding an unprecedented share of the notes because foreign and institutional demand is absent. This will trigger a panic in the bond market. The Fed will announce yield curve control, explicitly capping long-term interest rates by printing unlimited money. This is the formal admission of the liquidity trap. Inflation will become unanchored, moving persistently above 5% in the U.S. even during economic slowdowns, true stagflation. Regional currency blocks will solidify, a yuan bloc in Asia, a revived sterling area in parts of the Commonwealth, a eurozone deepening, and a commodity-based trade bloc among BRICS plus nations. 2035 to 2050, the reset and new equilibrium, stage 7. No single currency will hold over 50% of global reserves. A multipolar system is institutionalized, likely centered on the IMF's special drawing rights, SDR, basket, but with gold playing a significantly enhanced role. The U.S. will face a brutal fiscal adjustment. Federal spending will be forcibly cut or funded by explicit financial repression, caps on bank deposit rates, capital controls. The era of global policing ends due to fiscal exhaustion. A new, technology-enabled anchor will emerge, whether a CBDC network governed by a consortium or a truly gold-backed digital currency from a consortium of commodity exporters. The United States' share of global GDP, already declining, will fall below that of China. It will remain a wealthy, powerful nation, but appear among several, not the hegemon. The pattern is clear. It is etched in the financial records of dead empires. The 7-stage cycle is a law of economic gravity. You can defy it only until you can't. The confidence dividend has been spent. The weaponization of the dollar has triggered the silent run. The liquidity from decades of deficits is now trapped within a failing system, seeking escape into real assets. The timeline is compressed. The data is unambiguous. This is not a political statement. It is a mathematical and historical inevitability. All empires believe their era is different. Their technology is superior. Their institutions are smarter. Their culture is exceptional. The markets always prove them wrong. The question is not if the dollar's unipolar dominance ends. That phase of the cycle is already concluding. The only question is how fast the final stages unfold, and who is prepared. The clock started in 1944. It is now 80 years later. You are living through the fifth act.